Alright, so we're taking a look at Tesla stock, and in this video I'm going to break down what we saw today and also highlight some things that we absolutely have to pay attention to going forward for tomorrow, right? And also talk about some things we want to pay attention to from the perspective of an investor in Tesla, but also someone who's trading Tesla. Two different perspectives. So we'll go ahead and break it down. So what did we see for today? Well, we saw that it was very choppy for Tesla in the sense that we sold down, we went up, we came down, consolidated towards the end of the day, and if you actually look, we closed at around 256 and 94 cents, which was relatively flat in comparison to where we closed yesterday, right? Yesterday we closed at around 256 70 something cents, so give or take 30 or 40 cents, right? That was the delta between what we closed yesterday and today. So it was a flat move, and this is in sync with exactly what I told the Push and Profit private group this morning. In fact, I'll go ahead and pull up the snippet. So I said, at 8:53 a.m. Before the market opened, I said, following a surge in the markets yesterday, and I'm referring to the huge move that we saw with Tesla and the overall markets yesterday, right? And getting back to what I said, the question on everyone's mind is whether we'll witness another rally today. Now, consecutive days of skyrocketing market activity are rare, especially when new data is still coming in. It's unlikely unless that data is overwhelmingly positive. Now, we'll go ahead and break down that data as well further in this video so you guys can stay abreast of what we want to actually pay attention to. Now, I said I'll certainly keep an eye on intraday movements, which I did. I provided some trade ideas for Tesla that yielded some nice rewards for anyone in the private group that took advantage of those trades. But I said odds are that the market will stabilize today. And so that's exactly what happened. We consolidated. Stabilization, consolidation, whatever you want to label it, we pretty much moved flat, right? But going back to it, I said, with that said, we continue to stay ahead of the curve. For some time, I've emphasized the importance of watching yields, a topic largely ignored by market pundits and so-called gurus. Now, when I say gurus, I'm referring to the individuals that you'll often see on Twitter where all they know how to do is draw squiggly lines on the chart. The individuals who are chartists and all they do is just draw lines, right? These are the individuals where if you ask them, well, do you understand the fundamentals for a company? They'll say, no, all I care about is price action and volume. And then you say, okay, well, are you paying attention to the economy? And again, they'll say, no, I don't know any of that. I just pay attention to price action and volume. And so all they know how to do is just, draw these lines on the chart. And if a stock goes up, right, you'll ask them, well, why did the stock go up? They'll say, oh, well, it broke resistance, so the stock went up. And then, inversely, if something falls down, you'll ask them, well, why did, a stock fall down? And they'll just say, well, it broke a major level and it fell down, right? And so that's the only way that they look into the market. It's a very myopic approach, right? I try to look at multiple data points and I talk about how you want to pay attention to what's going on in the economy because a lot of what's going on in the economy and also paying attention to the fundamentals, that influences the price action for a stock, right? There's a lot to take in. The markets are more dynamic than we tend to give it credit for. So that's what I mean by these individuals who they don't look at the treasury yields. They don't look at what's going on in the economy, right? So, and I lost my train of thought. I said, so, finally they're starting to catch on. I'll bet, or albeit belatedly, right? So, now we're starting to see individuals on Twitter mention about the treasury yields, and this is something I've been talking about for a while on this channel, right? Now, I said the lateness is reminiscent of the hype around AI stocks, right? After they soared, industry commentators began to sing praises, proclaiming that anyone not invested in AI was missing out. Yet, by then, the evaluation of AI stocks have multiplied astronomically. So, what do I mean by that, right? Well, let's go ahead and take a look at Tesla, right? So, a lot of these individuals are always late to the game. When AI and a lot of these AI stocks are companies that benefited off AI, like Tesla was one of the names, Nvidia, etc. When these stocks are at all-time highs, that's when they're like, hey, you got to get in, right? But again, they're habitually late in the sense that you don't want to get in when things are just overextended. I was one of the ones where if you were part of the Push and Profit private group or you've been watching me on YouTube, I said, hey, 2023 is going to be a two-faced type of year. We're going to have a large, upside in the beginning of the year, but the second of the year, there's going to be a lot of rockiness and uncertainty, and I'll go ahead and break that down, right? I've said it in previous videos, but I may go on. But, part of the reason why it was evident that we were going to rally tremendously was just, look at how much we sold off in 2022, right? And so, there was different data that was coming in that was just pointing towards a rally for the markets, but let's go ahead and go back to a 5-minute time frame and go ahead and finish this. I promise I won't go off tangent and I'll finish what I said this morning, right? But I said the true insightful data points to monitor are the upcoming job reports and the personal consumption expenditure index, right? And which I'll continue to keep you guys updated with. Now, this was just a fraction of what I said this morning to the Push and Profit private group. If you guys want access to that, where every single day you guys get updates on daily briefings and I provide trade ideas, it's going to be the first link in the description below, right? But let's go ahead and talk about that. So job data. Well, that's something I covered a lot in yesterday's video, right? And yesterday we had the job openings report come out, and we saw that the minute the report came out, that was when we had the biggest candle for Tesla, just showing you guys that this data has a huge influence on the markets, right? And so what did we see yesterday in yesterday's job opening reports? Well, we saw job openings contracting. Now, we're in this weird area, right? And I say weird because generally speaking, you know, you don't want to see jobs contracting. That's not good, right? But we're this area where the reason why the market's pricing in and being very bullish and optimistic when we're seeing jobs, pretty much decline is or job openings, right? Is simply because we know that Fed Chairman Jerome Powell in his Jackson Hole Symposium speech mentioned how at the end of the day, yes, inflation is, coming in a direction that the Fed wants it to go in, but they're really concerned about the labor market, and their concern is that it's too tight. Now, they're not saying this so to say, but essentially they want to see unemployment tick up a bit. It's sad to hear that, this is what they want, but at the end of the day, they're trying to adjust that Phillips curve, right, which is like this economic term where, yeah, you want to have maximum price stability and maximum employment, but there's going to be some sacrifice, right? In order to bring inflation down, they need unemployment to rise, right? It's the unfortunate sacrifice. And so that's why a lot of the bad data, right, is kind of good for the markets. And so hopefully that makes it a lot easier for people to understand. And so we'll go ahead and break down the data that came out today and talk about it. Now, before we do so, let's go ahead and talk about the 10-year treasury, as we often do. So we saw that pretty much the 10-year did come down a bit today, which was good, but then it pretty much just consolidated. And we'll take a look at for example, SPY, right, the S&P 500, we saw that we moved up. So it was overall an upward day for the market, but it wasn't a day where there was significant, rockets going upwards, right? We saw that there was, it looked like treasuries kind of started ticking up towards the end of the day. And so I say for those who watch this channel and those who are part of the Push and Profit private group, if you want to understand the direction for intraday plays, you want to pretty much have the 10-year treasury note up, so you could pretty much kind of understand what's going on, because as I often say, there's an inverse relation between treasury yields and stocks, right? And so you guys don't need to have any fancy software like the Bloomberg terminal. You guys could just pull up wallstreetjournal.com and have this pulled up. It's completely free, right? So what came out today? Well, we had the ADP employment numbers come out, and we saw jobs added in 177,000 jobs, which was good because this was actually lower than the expected. I believe is around 200 or 195,000. So again, we're in this weird area where seeing some softening in the labor market is pretty good for the markets. Although this wasn't hugely positive, it wasn't that big of a beat. And one of the things I want to point to is if you scroll down, right, and we actually look at where jobs were getting added, right, we could see a lot of data here. So we see that goods, natural resources and mining's up 5,000, not a huge amount. Construction up 6,000, manufacturing up 12,000. Now, generally speaking, in a booming economy, you want to see manufacturing and construction going upwards because that just shows that there's growth, there's expansion in the economy. So these are pretty low numbers, right? Well, okay, this is what we've been seeing. And of course, when we look at the leading economic index, we've seen it contract for a while now, which kind of shows signs that, hey, things are not looking too good. The Fed is hoping for a soft landing, but it's still unsure whether that's going to happen, right? But let's go ahead and look through. So we saw services, trade, transportation, and utilities added 45,000 jobs. Nice. Information, 5,000. Okay. Financial activities, 0, right? Now, this makes perfect sense, right? When we have rates at these high levels, it makes it hard for financial service jobs to actually start hiring, especially with rates so high. It's like, who's going to want to refinance their mortgage on their house when rates are at these high levels? And so that, these mortgage bankers are struggling. And, I used to be a banker, right? And if I was still working at the bank today, I would 100%, tell you guys that it's probably difficult right now. It's probably difficult to, build up your loan volume and get people to, get new credit cards and loans when their debt to income ratios right now are probably way off, right? We're seeing I've talked about in previous videos how consumers are stressed out with their capital, and they're spread thin. And so, I'm sure bankers, right, mortgage bankers, a lot of the people in the finance industry are struggling, and that's reflected here. They're not hiring, right? We see professional and business services up 15,000, education and health services up 52,000, leisure and hospitality up 30,000, and then other services 7,000, right? So let's go ahead and talk about these two because these are pretty important, right? So education and health services. Typically, when everything else is down and the only thing up really is education and health services, that's what a lot of economists refer to as the late stage of the economic cycle, right? Or the macro cycle. Because typically education, teachers and people working in the health industry, those are jobs where regardless if we're in a recession, they're going to stay up. And so once you start seeing everything else down but these types of jobs up, well, that's concerning, right? Now, leisure and hospitality up 30,000. What we've been seeing is a lot of the, hospitality jobs at these hotels. Yeah, they're kind of starting to finally recover a bit more from COVID, but it's not, what we're seeing is a lot of these other jobs doing bad, and a lot of these lower skilled jobs not, just kind of grow a bit. And so, why are we seeing this? Well, I mean, ever since COVID, things have changed drastically. I'm sure you guys. I don't even have to say it, but for those of you guys that may not believe it, right? If you've been to a hotel ever since after COVID, you'll notice an immediate difference, right? So back then, before COVID, you went to a hotel and you'd have a bunch of people working in the, I think it's called housekeeping or cleaning services, whatever the title may be, right? And they would all have a bunch of them working. They would every morning knock on the door and say, "Oh, housekeeping," and you let them in regardless, right? Ever since after COVID, right? We've seen a big shift where now if you traveled, and I did a couple of trips this year, Chicago, South Carolina, Texas, just to name a few, right? And every hotel I stayed, it's the same, where when you go to these hotels, they no longer have a bunch of people employed in housekeeping, right? Those jobs are still recovering, and so they just have maybe one person, two people on the shift, and in order to get the room clean, you have to request it. You're like, you go to the front desk, and they're like, "Oh, well, ever since COVID, if you guys want new towels, you have to call. You don't just have someone coming up." And so what we're starting to see is leisure and hospitality is now starting to recover, but still, that's not a good sign for the overall market. Again, you want to pay attention to manufacturing and construction, right? And I know I'm going off tangent, but it's important to really understand this data, to really understand what's going on with the overall markets and also with Tesla, right? So let's go ahead and move forward. Let's talk about what we have to see for tomorrow. So for tomorrow, we want to pay attention to the PCE report, right? Now, I've said a multitude of different times on the channel that the PCE is another inflationary gauge. And in fact, it's the inflationary gauge that the Fed actually prefers to watch, right? It's like the CPI, but it's actually what the Feds prefer to watch, right? And so this is huge. This is coming out at 8:30. So if we had good data, right, and I'll go ahead and tell you guys what my expectations are for tomorrow. Again, I don't have a crystal ball, but I'll go ahead and provide what I think tomorrow's numbers will be. And of course, we'll see what happens tomorrow, and we'll move accordingly, right? But if we have good data for tomorrow, right, well, what is good data? Well, seeing inflation actually either move up just a small bit, which would bring the year-over-year PCE down, which would be good, or just moving flat, because again that would bring the year-over-year PCE data job. I'm saying this terribly, right? That would bring it down, right? Now, if we see it, just actually tick upwards, well, that's not going to be good, right? Now, I don't think there's going to be a huge move over for tomorrow for the PCE report. In fact, yesterday we had the pending home sales, right? And I want to show you guys this. We saw that pending home sales rose by 0.9% from the previous month, right? Now, still transactions for homes are down 14% for last year, but this tells you that we're still seeing, some demand in the housing market. Well, what does that mean? Well, one of the things we have to understand is that, when we look at inflation, these inflationary reports, a lot of it is really held up with shelter. Shelter makes a huge portion of it, and shelter is a lagging indicator, right? It has this lag effect where it's going to take time to really see that actually contract and reflect into the overall, these inflationary reports. And so with that report yesterday, the pending home sales, that's kind of an indicator that PCE numbers I don't think are going to be that great. Now, of course, I could be wrong, and if they are, we could see the markets really do well. And then, of course, what's going to happen after that? Well, the next data point for this week is the U.S. non-farm U.S. non-farm payroll and the unemployment rate and hourly wages. Now, I know some individuals might say, but we just got job data. Well, the data we got today was ADP employment numbers, and this is seen as like the private sector, right? It's different from the numbers that we get from the government, right? And oftentimes, recently, many have been saying, well, this is usually a precursor to what we see, and many have been seeing this as more accurate as we are seeing a lot of revisions for the government numbers. But again, it makes sense that there's a lot of revisions when we're at these certain times, right? It's gonna happen, right? So we want to pay attention to non-farm payrolls on Friday. Unemployment rate, huge thing, because of course, Thursday, tomorrow is going to be huge. We want to see what happens. But then after knowing what that report is, you want to go ahead and see what the unemployment rate is. Because if we have bad data, right, or just like flat CPI, nothing too drastic for the Fed to really cheer on, right, and just be excited about, and then the next day we have unemployment stay relatively flat, well, that's going to tell a story, right? What is that going to tell? That's going to tell the story that the Feds still have work to do, right? And they're going to be concerned, oh man, the labor market's not loosening up, and they may consider hiking. Now, I don't think that they're going to hike in September, although I have this theory, and I could be completely wrong, that they may end up hiking in the meeting after September just to assert, confidence and make sure to have their boot on the neck of the labor market, so to say, right? And I don't think it's actually needed. I think the Feds are going to be tightening until something breaks, but I think that that's something that we may see. And so this is why we want to pay attention to these two data points coming out this week. Again, what we saw yesterday with the markets rallying up was really just after we saw that positive job data. And so we want to pay attention to that. Now, with Tesla, there was some other news, but it's not news that I find too significant. Wall Street Journal today posted a story about how Elon Musk, again, is still under investigation by the SEC and Department of Justice for basically there was some glass materials purchased that were not documented. And, when you're running a public company, there's a certain amount of when there's certain amounts of being spent, it has to be documented, and it exceeded that amount. And so the question is, well, were there, funds that were allocated and misused? So that came out today with the Wall Street Journal. But nothing too significant with Tesla news. Of course, maybe after this video, something could break out. But again, we want to stay, data dependent. Pay attention to the job reports, as I believe that's going to be a huge factor for what we see in the overall markets. And again, continue following up with the Treasury yields. But with that said, I'm going to try to keep this video just short and sweet and end it right over here. No need to go any longer than what I have already done. And I'll see you guys on this next video right over here. Take care, guys.